Welcome back. We are going to be moving on to the valuing of plant assets. So understanding some of the accounting issues associated with that. So the question is, how do we value this? Now, we're going to be primarily focused on when we deviate from just out-of-pocket costs. We talked a lot about which costs go into or get capitalized into property, plant, and equipment. Now, what happens if it's not exactly just cash? Like, it's easy if we're just paying cash. That's pretty basic historical cost. What happens when we deviate from that? So if we deviate from that, companies should record property, plant, and equipment at the fair value of what is given up, or at the fair value of the asset received, whichever one is more clearly evident. So whichever one's more obvious. Now, this comes into play when we start giving things, as I said, other than cash. So if we're trading assets, this comes up. If we're giving, say, stock or marketable securities or debt, and the question is, well, what's our acquisition costs? Well, it's the fair value of what we give up or the fair value of what we get, whichever one is more clearly evident. Sometimes that's going to be the stock, but if it's of a private company or if it's of your small company, that may not be clear, may be actually more clear when you talk about, well, what is the value of whatever you're acquiring? So some things to keep into mind here. So we have cash discounts. So we've talked about cash discounts. These are discounts for prompt payment. That'll change the amount that what gets acquired. If we have deferred payment contracts, where we don't have to pay right away for an asset. So assets purchased on long-term credit contracts are at the present value of the consideration exchange. So if we have to pay, say, $100,000 in 6 years, then we actually have to take what's the present value of that $100,000 today? That's actually the cost. And then everything else is actually interest expense going forward. If we have, say, what we call lump sum purchases, so we're buying a bunch of different items. How do we allocate the cost associated with those? And basically it comes down to you do itemization. So that happens when you're acquiring, say, even a whole nother business. There's a big valuation exercise that you do. You go through and you identify all the specific assets that you're acquiring and you assign a new value to all those assets. And that's what they're brought onto your books as under purchase accounting. And then, say, if you're issuing stock, well, as I mentioned, it's not always clear that the stock has a more readily available value than the asset you're acquiring. So if I have a private company and I'm giving them stock and they're giving me a new car, well, the new car actually likely has a more readily available or determinable value than the stock in this private stock that I'm giving up would. So if we have exchanges of non-monetary assets, so this is ordinarily accounted for on the basis of fair value of the asset given up or the asset received, whichever is more clearly evident. Companies should recognize immediately any gains on the exchange when the transaction has commercial substance. So this is if we have gains and losses. Now, non-monetary exchanges, this means it's not at least all cash. It's a non-monetary exchange. Now, there's a lot of abuses that can happen associated with non-monetary exchanges because you can have transactions that don't actually have commercial substance. Now, commercial substance brings the question, well, what is commercial substance? Well, exchange has commercial substance if the future cash flows change as the result of the transaction. So if the two parties have economic positions that change, then the transaction has commercial substance. If there's really no change for the two parties, then there's no commercial substance. Now, when on earth would you have a transaction that does not have commercial substance? Well, great question. There are a lot of what we would call sale-leaseback transactions that have questionable commercial substance, especially depending on who it's with. If it is with, say, a semi-related party, then it may very easily not have commercial substance. So a sale-leaseback transaction, let's say I have a building that I'm currently paying a mortgage on. And so instead of paying the mortgage, what I'm going to do is I'm going to sell the building to somebody. And in this case, it would have no commercial substance if I sell the building to somebody and I financed it for that person, and then I continue to pay that person rent equal to the amount of my mortgage payment. So the question is, well, what's changed? Well, the only thing that's changed is that the building is no longer on your books. But otherwise, you instead of having a building, you now have a loan out to the person who bought the building, and you're still paying the mortgage, the cash flow, instead of paying a mortgage, you're now paying rent. So that would not have commercial substance. So, and the question is, well, then why would you do it? Well, you might do it because let's say you sold the building for something more than you bought it for. So you would have a big gain on the sale of that building. You might even sell it for fair market value, in which case it allows you to take a gain on the value increase of that building, even though there's no change in your future cash flows. So that is a situation when a company may be incentivized to do that transaction. And at the same time, that transaction would actually have no commercial substance. So these do happen. There's a reason why that commercial substance criteria is here, because non-monetary exchanges have a strong propensity for abuse. And that's just one brief example of when that might happen. So now, depending on commercial substance, I've just talked about what commercial substance is, it does change how we account for things. We cannot take gains on a transaction that does not have commercial substance. That's kind of that's the one big bottom line. If it does not have commercial substance, you cannot recognize a gain. You still get to recognize a loss. If you realize a loss, it doesn't matter whether it has commercial substance or not. You recognize the loss. Now, if there is some amount of cash received, so it's not fully a non-monetary exchange, if there is some amount of cash that changes hands, then you can recognize a partial gain up to the amount of cash you received. So if we take my building example, but now let's just change this a little bit. Instead of the company itself taking a loan receivable from the acquirer, let's say the acquirer went out and got a bank loan to acquire this building, and they paid me as the company cash. Well, in that case, I get, if it was all cash, then I did indeed sell the building, so it has commercial substance, and because there's cash, I would get to recognize a gain associated with that because I got some portion of that in cash. Even if I got a down payment, I'd at least be able to recognize the gain up to the amount of the down payment because that's the amount of the cash received. So that's the quick breakdown. We'll work through this a little bit. So in loss situations, companies recognize losses immediately. It does not matter. Now, quick illustration for the valuation of property, plant, and equipment in a non-monetary exchange, or at least partially non-monetary exchange. So we have Information Processing Inc. trades its used machine for a new model at Jerry Business Solutions. The exchange has commercial substance, so they can recognize a gain or a loss. The used machine has a book value of $8,000 and a fair value of $6,000. So it's worth $6,000. Its book value is $8,000. So the new model lists for $16,000. Jared gives Information Processing a trade allowance of $9,000 for the used machine. Now, it's a trade allowance of $9,000, but the machine only has a fair value of $6,000. So they're giving them more than what the fair value is, which accounting just kind of ignores that. Now, Information Processing computes the cost as follows. So the list price was $16,000 minus the trade allowance of $9,000, which gives us cash payment due of $7,000. Now, $7,000 is the cash that's going to be due. The fair value of the used machine was $6,000, which means the cost of the machine is actually $13,000. It's the cash due plus the fair value of the used machine. So the amount you paid plus the fair value of what you gave up gives you the total cost of the new machine. So Information Processing records this transaction as follows. So the equipment comes onto the books at $13,000. That is that's the cash price plus the value of the trade-in. That's $13,000. The accumulated depreciation from the old machine goes away, so we're going to debit accumulated depreciation for $4,000. There's a loss on disposal of $2,000. That's the difference between the fair value of the used machine and the book value, $8,000 and $6,000. The loss on disposal is $2,000, and we get to we need to take off the old machine off of our books, which had a gross book value of $12,000. So we're getting rid of the old book value of $12,000 and the accumulated depreciation of $4,000. The new machine comes on at $13,000, and then we have a loss, which is the difference of $2,000. So that is the recording of that with the cash going out of $7,000. So that wraps up. That's kind of the full recording of that transaction. Now, in a gain situation, in a gain situation, It differs between whether the transaction has commercial substance or does not. If it does not have commercial substance, there's no gain recognized. If it has commercial substance, you do get to recognize a gain. So in a gain situation that has commercial substance, let's say a company usually records the cost of non-monetary asset acquired in exchange for another non-monetary asset at the fair value of the asset given up, and they immediately record the gain. So here's our example. Interstate Transportation Company exchanged a number of used trucks plus cash for a semi-truck. The used trucks have a combined book value of $42,000. The Interstate's purchasing agent, who knows this, indicates that the used trucks have a fair market value of $49,000. Now, book value of 42, fair value of 49. So there's a $7,000 gain there just between the fair value and the book value. In addition to the trucks, Interstate has to pay $11,000 cash for the semi-trucks. They compute the cost of the trucks, which is the fair value of the trucks exchanged, plus the cash paid of $11,000, which gives them a total cost of the new truck of $60,000. So there's our total cost of the trucks. And to record that, they're going to put the $60,000 truck on their books. They're going to get rid of the accumulated depreciation on the previous trucks of $22,000. They're going to get rid of the previous truck balance of $64,000. And they're going to recognize a gain, which is a credit of $7,000. And then lastly, cash goes out the door of $11,000. So that's how they're going to record this. They get to recognize the full gain on this transaction because it has commercial substance. Now, if it lacks commercial substance, now let's assume the same transaction except it lacks commercial substance. So instead of getting to recognize the $7,000, we have to defer the gain on the $7,000, defer that gain on the $7,000. So we're going to defer the gain. And note, we did not receive any cash. Because we didn't get to receive any cash, we get to recognize none of the gain. We defer the whole thing. Now, if in this transaction we had received cash, then some of that gain we would actually get to recognize. But because we didn't receive any cash, we get to recognize none of the gain. So the semi-trucks, the new trucks come on at $53,000, not the $60,000, because we're deferring the gain. So we don't get to recognize the gain, which is a credit of $7,000, and that reduces the book value of the new trucks coming on by the $7,000. So what was $60,000 now becomes $53,000. We still have to get rid of the old accumulated depreciation on the trucks. We have to take the old trucks off our books, which is a credit for $64,000, and cash still went out the door for $11,000. So that is how we record this transaction. It's the same, except there is no gain recognized, and we reduce the value of the semi-trucks coming in by the $7,000 that had been our previous gain. So we are deferring that gain. Now, when we actually sell off those new trucks, we could actually recognize that gain at whatever time we dispose of those trucks. In the meantime, the basis just continues to roll. Now, let's say it lacks commercial substance, but it has some cash received. So as we mentioned, when you receive cash, you get to recognize gain up to the percent of the cash received. So the equation for that is actually the cash received, which is called boot, over the total amount, which is the cash received plus the fair value of the assets received. So that's the total amount of the transaction. So it's the cash over kind of the total amount of the transaction times the gain. So if we got half of the value in cash, well, then we could recognize half of our gain could get recognized because we received cash. So if we take an example, so Queenland Corporation traded its used machinery with a book value of $60,000 and a fair value of $100,000. There's a $40,000 gain there. And it receives in exchange a machine with a fair value of $90,000 plus cash of $10,000. So it did get $10,000 cash, which is actually some portion of the price. So our total gain is $40,000. That's the book value, or the difference between the book value and the fair value, is $40,000 gain. Now, how much of the gain do we get to recognize? Well, we got $10,000 of cash. So in our numerator, we have $10,000 of cash received. Now, what portion of the sales price is that? Well, it's the total transaction is $100,000. The $10,000 of cash received plus the $90,000 which is the value of the vehicle given up. So the total transaction is $100,000. 10,000 of that was in cash. So 10%. We multiplied 10% or 1/10 by $40,000, which is the total amount of the gain. So we get to recognize $4,000 of gain today on this transaction. So if we were to record that, we're going to record cash of $10,000 because we got cash. The new machine comes on our books at $54,000. Now, that's not the full value of the new machine, again, because we didn't get to recognize the full gain. And that gain is going to go against the value of the new machine on the books. We have to get rid of the old machine's depreciation, which was $50,000, get the old machine off the books, which was $110,000, and we get to recognize, as we said, $4,000 worth of that gain. That $4,000 gain gets recorded as a credit. That will hit our income statement as a gain on the disposal of the machinery this year, and that is how we are going to record that transaction. So if we move on to contributions, so accounting for contributions, let's say we received assets in payment for something, not like a owner contribution, but like payment. So in general, we're going to take the fair value of the asset received, and that's what we're going to use to establish that asset on our books. And then in terms of the contribution, we're going to recognize that as the revenue. So the other side of the transaction is the revenue we're receiving. So we get revenue in. That revenue is in the form of an asset or property, plant, and equipment instead of in the form of cash, or accounts receivable, which is usually what we're seeing. So that's the contribution. So let's take an example. So Max Wire Meatpacking has recently accepted a donation of land with a fair value of $150,000 from the Memphis Industrial Development Corporation. In return, Max Wire Meatpacking promises to build a packing plant in Memphis. So they received this. Now, what do they do with it? So they get this land that came in for $150,000 because that is the value of the land. So now they have this on their books, and they get to recognize revenue, which is contribution revenue. They were given this land in this case with the goal of doing something with it. So they're recognizing that as actually revenue. That's contribution revenue to the company of $150,000. Now, when a company contributes a non-monetary asset, it should be recorded the amount of the donation as an expense at the fair value of the asset donated. So now we're kind of flipping it, where instead of receiving the asset, we're actually giving it up, and we're going to recognize an expense for the fair value of the donated asset, not our historical cost or not our book value. It's going to be the fair value of the asset given up. So take an example. So we have Klein Industries. They donate land to the city of Los Angeles for a city park. The land has a cost of $80,000, but it's valued at $110,000. So to record the transaction, they actually have a contribution expense of $110,000. The land comes off the books at $80,000 because it was only worth $80,000 on our books, or it was recorded at $80,000 on our books. It was not on our books at $110,000. And the difference actually is a gain on the disposal of the land. It's as if we sold it. However, we just recognize an expense for the full value of the land. The idea is we could have just sold the land and then given the cash as the donation, which would have equated to this without the transaction costs. But in this case, we're recognizing an expense for what we're giving up, the value of what we're giving up, and the difference between the value of what we're giving up and the book value is a gain on the sale of the land or on disposal of the land of $30,000. Moving on to how we account for costs subsequent to the acquisition. So in general, once we now have the asset, regardless of whether we acquired it or exchanged for it or received it as a contribution, we now have the asset. Now we're going to utilize this asset to produce things, and we're going to have expenses associated with this asset. We may improve it and make it better. We may just have to pay to maintain it and keep it functioning. So what do we do with those costs? Well, in general, costs incurred to achieve a greater future benefit should be capitalized, whereas expenditures that simply maintain a given level of service should be expensed. Now, this is all subject to materiality, and again, you have to take into consideration what's the duration that we're dealing with here. Now, a lot of maintenance costs don't have more than a 1 year life anyway. Like when I change the oil in my car, one, it's not increasing the value, the usefulness of the car. And frankly, I'm going to have to do this multiple times a year. It's not like changing the oil has like a 5-year lifespan on it. It has like a 6-month lifespan, and I don't hardly drive it all. All right. So think about it. There's a couple different factors to take into consideration here. So in order to capitalize these costs, one of 3 conditions have to be present. One, the useful life has to be increased. So we have to be increasing the useful life. Now, this is where it's kind of like, well, if you don't change your oil, your car will explode. So if you change your oil, you are increasing its useful life. Yeah. Oh, that's not how we're talking about here. The quantity of units produced must be increased. So these are things that have to be present. So at least one of these has to be present to capitalize it. You have to increase the useful life, increase its production ability, either in terms of the number of units, quantity, or the quality have to be increased. So that's usually what's required. So there has to be some improvement in the asset. Keeping the asset functioning the way it's currently functioning is not capitalizable. That's maintenance. So those are the 3 categories that were generally considered. So in terms of how these usually end up getting broken out, so we have different types of things. We have what we consider additions. These increase or extend an existing asset. So if we took a building and we built an addition on it, well, that's an addition. We made it bigger, we increased it. If we made a piece of machinery bigger, or we increased the size of its motor so it could run faster, right? That's an addition to it. It could be an improvement or replacement. So if we're just improving it, that would be like, say, increasing the size of the motor on something, or upgrading the software in it to make it more useful. That would be an improvement. Rearranging stuff. Well, let's say we had our facility all laid out and the layout was horrible. We came in and we spent a ton of money to move all of our machines around to increase our production flow. Well, that may be, that's generally going to be capitalizable. And then repairs typically are not capitalizable. These are expenditures to maintain an asset in its current condition of operations, or something very close to its current condition of operations. That's like oiling and greasing it, cleaning it. All those are just repairs. If it breaks, whatever, needs new bearings or something, those are going to be repairs. They are not increasing the productivity of that asset. So in general, additions get capitalized at the cost of the addition. If we have improvements or replacements, so if the carrying value of what's getting replaced is known, we have to take that off and put the new one on. Now, oftentimes that's not the case. When you build a piece of equipment, you're not usually capitalizing things at that level, in which case you don't know what it is. So if you don't know what it is, if the carrying value is unknown, then the asset's useful life is extended. That's if we are extending its useful life. Or if the quantity or quality of the asset's productivity is increasing, then we capitalize the cost of the improvement to its own account, which we generally call, say, equipment improvements or something like that. So that's if the carrying value is unknown. Now, if we're doing a rearrangement or a reinstallation, again, it comes down to, well, do we know what the original cost was? Now, if we know what the original cost of the rearrangement was, then that has to get taken off the books and we have to put the new cost on. Now, if it's unknown, then the cost is material that's applied for everything. Then we capitalize the cost of the rearrangement or reinstallation as a new asset. And lastly, repairs. Any ordinary repairs, their expenses incurred. If it is a major repair, it could be treated as an addition, improvement, or replacement. Now, that is going to have to be a major repair with an extended useful life, more than, say, a year at least, before it's going to start getting capitalized. So repairs can kind of go either way, but in general, an ordinary repair is expensed, and that's almost the definition of a repair. So that pretty much kind of wraps up what I wanted to cover for property, plant, and equipment. Hopefully that was helpful. We'll have a couple of more examples I'll probably work at a later time, but that gets us through this, which is good because it's now dark outside. So with that, have a great day and God bless.